Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One stock on the move is definitely Intel, up over 3%. It had a big gap higher here on the end of close on Friday on the rumors that maybe Qualcomm was looking at a possible deal for Intel. Then this morning, we learned that Apollo was offered to have made a multi-billion-dollar investment in the company as well. We wanted to get more on this with Liana Baker, Bloomberg News Managing Director of the deal team. She joins us here in studio. Liana, talk us through the Apollo part. What does that look like in your reporting?
Sure. So this is a potential investment. Apollo has made this offer to Intel. It's unclear if Intel is going to take them up on this offer, although Apollo is already a partner to Intel. They have a joint venture with them for their Irish plant, which was a really big project. So we're waiting to see how Intel decides to proceed. You mentioned there is an approach that came from Qualcomm late last week. So Intel has a lot to think about. Its board is meeting to decide which way to go. This Apollo investment could be an alternative potentially to the Qualcomm merger, or it could be something that happens before. Any deal with Qualcomm would take a long time, according to analysts, just due to all the regulatory bodies around the world that would have to bless this deal.
Now, was this expected in your reporting? Were there any whispers about this prior to this?
So we've been chasing for a long time what Intel is going to do. Since their disastrous earnings report over the summer, they've kind of put themselves in play. At Bloomberg, we were the first to report that the company was thinking about M&A options, about a potential split. And then you might remember that late last week, Pat Gelsinger put out a statement kind of laying out what would happen. We are watching to see what happens with the foundry business. Intel Foundries is something that Intel has spent a lot of money on over the years, and it's not making money. It doesn't have that many customers, and that is sort of sinking the company right now, even though it's kind of the long-term future play that the management has laid out for Intel.
What is in it for Apollo? I know you said that they have a joint venture, but why?
So Apollo is a turnaround specialist. They love complicated situations, putting money to work where maybe other pockets of Wall Street doesn't go. This is a perfect example. They've already invested in Intel. Intel clearly needs some confidence capital. They need someone on Wall Street to say, I believe in the future of this company under Pat Gelsinger. This is why, because the stock slide has been really remarkable to even be at the point where it could be considered a takeover target for Qualcomm, one of their competitors.
So where does Wall Street think that they should go? Qualcomm or Apollo?
We don't know at this point, and there could also be other suitors or, analysts are saying. We reported over the weekend that Broadcom, which some people have speculated could be interested, that they are currently not evaluating an offer for Intel. So right now, Broadcom's on the sidelines. Could that still change? We'll keep an eye on it. But Intel has a lot of options to consider. It's going to be an interesting few weeks to see where things go.
Hey, can I ask a quick question? How does this impact the CHIPS Act, the investment from the Biden administration? Does that change at all in any of these scenarios?
It's all related because the U.S. government has a long-term ban on Intel as a manufacturer that's in the U.S. of chips, which are so critical. So the U.S. government is watching this all really closely. They want Intel to survive, whether that's with Qualcomm, whether that's with a capital infusion from Apollo. So they want to be part of the solution since Intel stands to gain a lot of cash from the government.
They want them to combine so they would tell Justice and the other regulators, hands off this one?
That would be interesting, wouldn't it?
Right. And it sounds like a conspiracy theory, but you have to understand that any deal that Intel does would need the blessing from the government. So sure, could the U.S. government tap Qualcomm on the shoulder and say, hey, do a solid for us and make an offer? I have no idea, but there's all these different theories that people are saying, and it's not that crazy to think people in D.C. might know more about this deal than we know right here.
Right. What's the most interesting thing that you found through your reporting?
I just love semiconductors. It's always interesting, and just to see an American icon like Intel faced with these prospects, and we're talking, this could be the largest tech deal of all time if Intel is somehow sold. So it's just amazing to be following this situation, because I've been reporting on semis for, over a decade, and you never know how this is going to go.
Well, also just how fast this all deteriorated. Like, I've read so many stories of sort of the decline in Intel and how fast it came on, and then we're talking about this moment where, like, Qualcomm might need to step in, Apollo might need to step in, the government might need to step in a particular fashion. That, to me, is really striking.
Is it also striking to you how quickly NVIDIA kind of caught everyone's imagination? And so it's semiconductors, it's cyclical, it depends on trends and AI, so it's so fast moving, and it's just been a spectacular industry to follow.
Yeah. All right, Liana, thanks a lot. Great reporting. Really appreciate it, Liana Baker, Bloomberg News Managing Editor for the Deal team, and joining us on that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We get a bunch of CEO interviews the next 2 hours. And I say a bunch because it's nice to get perspective kind of on the ground on where the growth is, where the worry spots are, how hiring is, what inflation looks like. So let's kick it off now with Signet Jewelers. So they had earnings on the 12th, and they did really well. They reported adjusted earnings and comparable sales for the second quarter that topped analyst expectations. The stock since then is up over 11%. Management said in the earnings statement that comp sales are positive so far in the third quarter. Some of the analysts are also saying, look, this was a better than feared quarter, especially when you look at the reiterated annual guidance. So we wanted to get an update from the CEO. Gina Drosos is CEO of Signet, joining us now from Seattle. Gina, walk us through sort of the highlights, like what you think that it really impressed investors, and then we can go from there.
Sure. Well, good morning. Great to be with you. Our team delivered a sequential improvement in same-store sales. It was the fifth quarter in a row that we've seen a sequential improvement. As you said, comp sales have been positive in Q3 to date. That's encouraging because in the jewelry category, and especially engagements, COVID is actually just ending. So while for a lot of businesses, COVID was in 2020, people tend to get engaged about 3 years after they meet, and people weren't meeting during lockdown in 2020. So we saw a 25% drop in the average number of people getting engaged in 2023. And that's been slowly coming back in 2024, but we saw that turn positive as we've entered the third quarter. So that was encouraging.
I wanted to know, of course, a lot of consumer companies have talked about how shoppers are watching their spending carefully. They're being very nitpicky. Is that something that you all have noticed at all? What does that look like for your business?
Yes, I think we've seen a cautious customer for most of this calendar year. An example of that is that we see customers coming to our websites 15% more often before they make a purchase than we did a year ago. So people are being careful in an environment like this. But when it comes to getting engaged, they might delay a little bit, just make sure they're getting the right value, which given our scale, we feel like we can very often offer, but they're still deciding to get engaged. And we expect that to pick up as we go through peak engagement season, which is during the holidays.
Hey, Jenna, it's John Tucker. Can I ask a quick question? I can see the price of gold, by the way, is at a record. How do you track diamonds? Because that's essentially a cartel that controls the supply and I guess the pricing there, right? How does that work?
No, diamonds trade just like gold does. They're a commodity. Many years ago, it was more of a monopoly situation, but that hasn't been true for a couple of decades now. There are multiple miners that mine diamonds around the world. Signet is one of only 5 retailers in the world that are vertically integrated and actually buy diamonds directly from the miners. We own our own cutting and polishing facility in Botswana, so we have a really good, I would say, a vertically integrated eye into what diamonds should cost, what metals should cost, how much it should cost to cut and polish a stone. And that's how we're able to bring great value to our customers.
Now, how do you control the sourcing or know where it comes from?
So that's really one of the places where Signet has shined and been a leader in the industry. Responsible sourcing is very important to our customers and to our company. And I and to my 20-something children, I should add. And so we are pristine. We can guarantee to all of our customers, we have what's called the Signet Promise, that we are confident that all of the metals and all of the gemstones, including diamonds, that we source are conflict-free and produced in a way that, that they would feel good about. So we trace that back to the origin of where the diamonds or where the metals come from, so we can be confident.
There's also the lab-grown diamond phenomenon. And when I was doing, packages on diamonds 15 years ago, that was like really taboo. Now I hear of younger people, and this is what they do. They want to save a little money, but they still want it to look pretty. What kind of market do you know is evolving here, and kind of what the pricing is and what the demand is?
Yeah, so lab-created diamonds have been broadly available in jewelry since 2019, so about 5 years now. Of course, they've been available for a long time in drill bits and things like that needed a hard substance to be part of it. But in jewelry, about 5 years. Every year since they've been in the market, the price has fallen about 15 to 30% actually. So they haven't really maintained their value over time, and that's because they're made in a machine and about 3 weeks, whereas a natural diamond is precious. It's made in the earth over 1 billion years. And so they're chemically the same, but quite different. And what we've seen is that consumers, if they are on a tight budget and want to get a bigger stone, lab created can be a great choice for them in an engagement ring. But it's particularly a great choice in fashion jewelry, where maybe it's not quite as sentimental a piece. That's where we really see lab created as having a bigger potential over the long term.
So just a tootle? Tell John Tucker. So a fashion jewelry is like, here's my super cool ring that I'm doing with my evening gown.
Everyone look at it. It's cute, right?
It's really big. Maybe it has a good shape that's kind of interesting, but I didn't have to break my bank for it.
Yes.
Now, is there some plan by you guys to try to get people to get married?
By you guys, you mean us, or do you?
No, not you
mean
two.
Gina?
Some evil plan where you pipe in romantic music to all your. There's got to be, right?
A ploy.
No, we don't. We don't plan, but I will say that we have a lot of consumer insight around that. Several years ago, we started tracking the milestones that couples typically go through between when they meet and when they get engaged. So, for example, they typically go to a movie or a concert before they say, I love you, or move in together, or meet the parents, or things like that. And so we, with our partners at Google and Meta, have identified 45 trackable signs or milestones that couples typically go through. Once they've crossed over 26, they are statistically significantly more likely to get engaged in the next 12 months.
The more you know.
And one of the
when they have their
things
first fight.
I'm learning a lot.
Yeah.
This might be speaking right to Norah.
Right, as I'm thinking about the future.
It's super interesting. And that's one of the things we said in our second quarter call is that there's a 900 basis point increase, or 20% more couples that crossed over that milestone in the second quarter this year versus the second quarter last year. So we really are seeing this ramp back up to a normalized level of engagements.
Aw, so happy on 10 o'clock on a Monday. All right, thanks so much, Gina Drosos. We really appreciate it. CEO of Signet.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
So natural gas prices are $2.57 MMBTU. It's much better than we were before. We were under $2 MMBTU, but still, considering the amount of demand globally that we need, that price is a little bit low. So we wanted to check in with the largest independent natural gas producer right here in the United States. They have world-class assets in Appalachian Basin, and that is Toby Rice, CEO of natural gas producer EQT. He joins us in studio. Hey, Toby, good to see you.
Good morning.
So do you like prices at $2.58?
Well, we are unique in the sense that our company actually can generate free cash flow at a price as low as $2. But that is not the case for the other producers in the United States. Our view is that the marginal producer in the U.S. requires about $3.50 to justify activity levels and putting rigs up in the air.
So when you look at prices, say, then under 3, or actually under 2, where do you sort of like just say we're just going to drill them, not complete them, and hang tight? And then when you kind of release it, and what does your inventory right now look like?
So right now, short term, people are looking at curtailments, and you have about 2 BCF a day of natural gas that's currently curtailed. This is as simple as just operators shutting in the chokes. That production could come back, and you'll see that pressuring prices up until about $3 range. But then after that, there's some short cycle activity that would come back, requires about $3.50. And again, that's sort of the price that you'll see with activity levels. So these shorter prices we're seeing right now are going to ultimately influence activity levels that are set as part of the 2025 budget planning, which will influence supply in the future, and we think is going to be pretty constructive towards the second half of 2025, where more LNG demand picks up and some of these activity reductions will start hitting the front lines.
Well, let's talk a little bit about AI. Natural gas is not, of course, at top of mind as an artificial intelligence trade, but some people are saying that rising power demand for more natural gas demand. Are you drilling to meet that demand at all? How would you all boost production?
Well, natural gas, about a third of it is used for power generation, so it is a very important dynamic to study and look at. EQT has an asset called Mountain Valley Pipeline, which is a very contested pipeline. Fortunately, that was put in service this summer. That's going to send about 2 BCF a day of natural gas down to the southeastern markets. And we just announced some deals, one of the largest physical supply deals with 2 very large utilities in that market to deliver up to 1.2 BCF a day of natural gas. Now, where is that natural gas going? Sure, it's going to help keep people's homes warm in the wintertime, but a large portion of that is going to power gen, and it's going to be replacing coal facilities. That would be enough natural gas to power about 8 gigawatts of power.
Now, one of the biggest problems in this whole scenario is how you move the stuff, and that's a pipeline issue, and that's an infrastructure issue. Where are those conversations now? In that, are we going to have data centers built near where you guys pump natural gas, or are we actually going to be able to get the pipelines in the ground to move it to where those data centers can be built?
Well, it always makes sense if you're an energy-intensive business to build your facilities close to where the energy is, and that would put Appalachia as a really great place to be. But just to step back at a very high level, what's happened in the United States over the last 15 years, and it really understands the natural gas markets. Since 2010, demand has grown 50% for natural gas. But during that period of time, natural gas infrastructure, pipelines, has only grown 25%. And most importantly, natural gas storage infrastructure has only grown 12%. What does that mean? That means we haven't built enough pipelines to keep up with demand, and our current pipeline system is maxed out. You're going to continue to see big disconnects between markets, like we're going to be selling our natural gas for $4 in Appalachia, and people in Boston and New York are going to be paying $10 to $20 for that natural gas. But the storage infrastructure is probably the most important dynamic. Simply put, natural gas storage is no longer sufficient to balance supply and demand. And what that means is that price is going to balance supply and demand. And so we would describe the natural gas markets going forward as being very volatile. And we think pricing could be as low as $2 you see now, and you see there's sort of a natural floor where operators will actually curtail production volumes. But we also think gas prices could be significantly higher than that. And the last structural piece of the puzzle has been the massive retirement of coal. Has traditionally been a replacement fuel when gas prices got high. And gas to coal switching would occur when prices would run in that, call it $3 to $5 range. Well, with coal gone, the lid on gas prices is significantly muted, and that means prices could run up closer to the $8 to $9 range. Those are the prices you saw in 2022, and that is the price where industrial demand will start shutting off. That's not a great place to be. The solution is get more infrastructure built in this country, both pipelines and storage infrastructure. And if you have the opportunity, build your manufacturing in Appalachia.
Interesting. I mean, we're right around the corner from the winter season. That's when I cry. It's going to be cold. Is the market oversupplied this winter?
Right now, we have about 300 about 300 BCF of extra gas in storage. It's about 8% higher than normal.
Billion cubic feet.
Yeah, and for perspective, the U.S. market is about 100 BCF a day. That's what the current supply is today. But this can be corrected very quickly in a winter period where natural gas demand in this country goes north of 120 BCF a day. Mm-hmm. So right now storage is a little bit oversupplied, but that goes away with just a normal winter. And when you think about the fact that we don't have the necessary pipeline infrastructure to deliver natural gas in that just-in-time scenario, it's going to put further pressure on prices, hence a lot of volatility towards the upside.
Here we don't have that much time, but you have a Southwestern and Chesapeake maybe merging up here. Where would you be looking to add M&A? Is it going to be pipelines or is it going to be producers?
So we just completed our transformation at EQT over the last 5 years, Alix, since taking over. We've been very purposely designing this business to be the energy company of the future. For us, that means we wanted to create a business with a low cost structure in a commodity business. Mm-hmm. That really is your only moat. We are really excited to say that EQT over the last 5 years has cut its costs by 30%. We now are looking at a $2 cost structure. We've increased our productive capacity by 50% over that period of time. And show me the money to our investors, we've increased our free cash flow per share by 2 times.
Huge, yeah.
So we've doubled that over. So we're in a great place right now. And we're just going to continue harvesting the success of the transaction we've done in the past.
All right, Toby, really good to catch up with you. It's been too long. Toby Rice, CEO of EQT, joining us. This is Bloomberg Intelligence. Happy Monday.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One of the top stories over the last couple of days has been that deal that Constellation Energy inked with Microsoft to help restart one of its nuclear power plants on 3 Mile Island. That investment about $1.6 billion. But Constellation Energy is not the only company doing stuff like this and talking to hyperscalers about how to provide energy for this massive demand for data centers and GPU chips. And one of the companies involved is also AES. It does a lot of different things. It sells renewable power to corporate customers. It deals with LNG infrastructure. It has 2 fast-growing utilities. It does a lot of stuff. Yet the stock has not performed like Constellation Energy and like Vistra, which are sort of the power plays on AI. So luckily, the CEO of AES is in the studio right now with us, Andres Gluski. Andres, nice to see you.
Very nice to see you too.
So why hasn't your stock gotten the same kind of credit that Vistra and Constellation Energy have?
Well, our stock recovered a little bit, let's say, in the last couple of weeks.
It has, yes.
But I still think, it has a long way to go. So we are the largest provider of actually renewable energy to hyperscalers in the world. So we have already 8 gigawatts signed over history. So I think that, the nuclear has gotten a lot of attention. I do think nuclear is part of the solution. But we're really looking at a market that's short energy to really be able to implement the AI revolution and the amount of data centers that are needed.
I know just last month you all were saying that you see demand at Midwest utilities rising 50% on data centers. So of course, that's really been the conversation about AI. What is your expectation for how much more power demand you'll need to produce to meet data center demand?
Well, the truth is right now, anything that you can get built on the renewable space in the right areas, you can contract. So there's really a shortage. In the case of the utilities, this is a very nice story because one of them is Dayton, Ohio. We call it AES Ohio. And it was really a city that had suffered a lot, with the deindustrialization of the U.S. And what we're seeing is we contracted for about 2 gigawatts of new data centers coming into that area. But you also have an EV plant and a battery plant coming in. So it's great to see this area reindustrializing and, growing again. So it's an area that, its population is probably half of what it was in the 70s. So there's a lot of, there's water available, there's interconnection, there's everything else. So it's really, it's a great spot to locate data centers.
A couple dumb questions for you. When we talk about renewable power to some of the data centers, for example, or the hyperscalers, what does that actually mean for AES? And what kind of partnerships do you currently have and who are you talking to? That was 3 questions right there.
Yeah. Well, let's see. Sometimes we're not able to say, who exactly are the different partners. What I can say is that it's, pretty much all of the big ones.
Okay.
We do have the largest solar plus storage project in the country being built right now. And that's with Amazon Web Services, AWS in California. And that's 2 gigawatts, just that one facility. So we have a backlog of about 12 gigawatts that we have to build over the next maximum 3 years, all of it. And we're signing of about 5 gigawatts a year. So to put it in perspective, something like, let's say, putting the unit on 3 Mile Island back online, that's probably about 850 megawatts. And we are talking about, 5 gigawatts a year that we're signing. So there's, I see nuclear as part of the solution, but it's not going to displace renewables, certainly not in the next decade.
And when we think about Microsoft striking that contract with Constellation Energy, do you feel like that positive sentiment has permeated through the market in terms of thinking about renewable energy utilities?
No, I think the market's still thinking of it a little bit like a zero-sum game. And it's not understanding sort of energy markets, because what nuclear can do is really provide dispatchable energy, which is 24/7. Renewables are intermittent. Clouds pass, sun goes down, wind stops blowing. So you can complement that with batteries, but you can certainly complement it with nuclear, and you can complement it with gas. So rather than an either or, it's both. Because per megawatt hour, and actually the energy you produce, renewables are the cheapest. They just aren't 24/7.
So then to that point, the reliability, the one argument is nuclear and SMRs, small modular reactors, are quote unquote better because they have more reliability, or natural gas has more reliability than for wind or solar. Now you were mentioning you're building this largest solar plus storage with AWS in California. How hard/easy is the storage world right now for you?
Storage is a little bit like a hammer. It has lots and lots of uses.
Okay.
The prices of batteries are coming down a lot. So as the prices of batteries come down, there are more uses that you can find for it. What's interesting about batteries is it can do stuff that, for example, a gas plant or even a nuclear plant can't do. They can go positive and they can go negative. So, for example, we have found that when you have a hurricane, having batteries is great because as transmission lines fall down, they were able to suck up that energy and actually allow the fossil plants to gear down and not get damaged. So that's very important. If you compare it to a gas plant, they're online 99.9% of the time. A gas plant will be online 10%, 20% of the time. So I think when there's a lot of excitement like SMRs, the great use I see of SMRs is putting them into retired coal plants. Because basically a big coal plant is just like a kettle. You just change the flame, the heat. So instead of burning coal, you would be heating up the water with a nuclear. So you get to reuse the steam turbines, the interconnection, all those things. The issue I have, with SMRs today is tell me what they cost.
No one knows yet.
And tell me when they're going to be ready. So I believe in the concept. I think they'll be, they could be a game changer. But we really have to see how much they cost, how many we can build before we're going to say that they're going to, significantly displace renewables.
Transport us to one of your boardroom meetings. What types of conversations are you all having right now, especially as we think about power demand?
Well, I think I'm very lucky I have a great board. We do a lot of scenario planning, and we've been doing that for 25 years. So we do scenario planning for regulatory changes, for demand changes. So I think, basically they're quite pleased because about 6 years ago, we really said, look, if you look at people's decarbonization goals, there's going to be a shortage of zero carbon energy. So we built up a pipeline. We bought rights to land. We did interconnection. So, we feel a little bit on the right side of history on these things. So I'd say generally the conversation is very good. So honestly, nuclear is not a main theme, for example, of my board of directors.
Talking about sort of the different projects, what's the hardest part about building stuff right now? Is it labor and materials? Is it getting the PPAs or the offtake agreements? So basically your customer has to sign up and say, okay, I'll pay you this much to get this amount of solar from you. So that gives you clarity on then what you have on your books. What's the hardest part?
The hardest part is getting permitted land.
So none of the things I said. Okay.
None of the things, no. The PPA would be simple. And look, we haven't postponed forget abandoned, not even postponed a significant project, even during COVID. So I think we have a very robust supply chain, and we will certainly move everything that's in the U.S. to domestic production by 26. So that is not worrying me. Labor, we've also not had a problem because we've tended to work with strategic contractors in the sense that we don't give them one project. We'll give them a series of projects so they can move the crew from one spot to another.
I see, that's interesting. Do you think permitting is going to get fixed? No matter who's in the White House, how do we fix it?
Look, they say all politics is local, all permitting is local. So, while they've made, let's say, progress, let's say in the way they do interconnections in the states, of batching it, of new ways of thinking about it, I do think that's going to be probably the biggest bottleneck. I think we have to, move renewables to some extent outside of certain areas where there's more resistance. So there's definitely going to be a move to putting renewables where, the permitting is easier, but that's the most difficult.
Can I ask you what kind of shape the grid is in from your perspective?
Oy. How much time do you have?
Look, I think it's a great question, and I'll tell you for the following reason. I think there's a lot of talk about, the shape of the grid, but what we're not doing is fully applying the new technologies we have. So, for example, grids are probably used at 50% of their real capacity. We have a lot of copper sitting around most of the time. So we have the biggest, what's called dynamic line rating project in the US. It's in Indiana. What is dynamic line rating? Very simply, you put sensors on the lines to say what's the actual temperature, what's the actual sag in the lines, what's the wind. And so in some cases, you can actually transmit 50% more energy over it. The second one is that the whole grid is built out for the peak time. The peak time could be 1 hour. The rest of the time it's underutilized. So by using batteries, we have projects called Grid Booster. You actually transmit the energy on the off-peak hours. So I'm not saying it solves everything, but I think we have to think more about these new technologies to make better use of the existing grid.
Before I let you go, what's the one thing that you hope is that investors take away in terms of, say, your stock price? Like, yes, it's recovered.
Sure.
But for the last year, it's still flat or down by about 1%. What do you think it's going to take for you to finally get credit, like Constellation Energy?
Well, I think what people have liked very much about the pure IPP plays is that they think there's little investment. So it's just using existing plants and just recontracting them. In our case, I think, look, we have met or beaten our guidance 8 years in a row. We have grown our dividend 10 years in a row. So I'm, by training, an economist, and I'm just kind of really surprised at some of the correlations in our stock. We're not sensitive to interest rates. So I think those things tend to work themselves out over time. So look, the company's never been better. We're triple investment grade. We have 3 years of construction in our backlog today.
Yep, that's great.
And a lot of very cool new technologies coming on.
All right, Andres, really appreciate it. It's always good to see you. So thoughtful. Andres Gluski, CEO of AES, joining us there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So around this time every day on Monday, we talk to Bloomberg BNEF. They are the leading researchers and everything you need to know about the energy transition. They do work on commodities and power and transport industry, ags. They also talk about finance and governments. And so everyone can make informed decisions on this. And joining us now in studio is David Doherty, head of oil and renewable fuels research for Bloomberg BNEF. David, great to see you. Thanks for joining.
Hi,
so this is Climate Week. So it's all going to be about climate-y, friendly, green things. Does that include your oil and gas?
It does, yeah. You can call oil green things, I suppose, if you want to get exciting about it. We've been talking about alcoholic-free beer, so oil can feature in the climate change transition as well, right?
So that was my way of kind of asking of how does oil and gas play in the energy transition, and what are some of the trends that we've noticed over the last year?
Yeah, I mean, if you think of the players in the oil market, they're the energy pros in the world, right? They've got the balance sheet, they've got the skills, they've got the technology, and they're already established, right? So they've got interest in seeing how this develops, how fast it goes, how it impacts their bottom line, basically.
What are the main holdups in terms of the transition? What are some of the headwinds?
I mean, capital is obviously one, raising capital, smarts, people in the right jobs in the right place, pushback, both political and from people, right? People love the idea, but as soon as it costs money, that's kind of difficult to swallow, especially now in like inflationary times, right?
Is the conversation that EVs will eventually supplant internal combustion engines and get rid of gas demand, is that still something that you guys are working with and modeling, or has that conversation evolved?
It's evolved. I mean, that is kind of the trend, though. Yeah, when you look at things when they're cheaper up front, right? Consumers tend to shift towards that. If it's cheaper day one for buying an EV versus an internal combustion engine car, and all else is equal, you're probably going to see a shift towards that, right?
So we're really, though, U.S. centric here, and we don't see that in the same way. But elsewhere, is that truly what's happening?
Yeah, you are. You're seeing a big uptick in Europe and in China, for example, and even here in the U.S. California, for example, behaves much more like a European economy when we think about the transition to EVs. We've seen really high rates of penetration there.
What are some of the main themes and market dynamics that your team is focused on right now?
Yeah, like the rate of this change is interesting, what's happening in different markets, what the response is. If you take the US, for example, it's a mature market. So when these EVs come into the market, you're seeing a decline in gasoline sales versus, say, in China, where it's like what could have been doesn't necessarily manifest, right? So that turns into then power in your pocket, right? You're seeing the cost of gasoline isn't coming down, even though you're expecting it to with less gasoline being consumed. There's so many more dynamics than just a four wheels on the road situation, right?
And how are all these things impacting the consumer?
Yeah, I mean, if you think about costs in your pocket when it comes to driving your car, that's a big thing, particularly here in the US, particularly in an election year. It trickles down into inflation. You get something delivered to your house. The cost of diesel impacts all of these things. So yeah, consumers are super sensitive of anything to do with cost at the moment. And probably the biggest development here in the US that's been interesting is less consumption of gasoline hasn't turned into less prices at a lower price at the pump.
Why do you think that is?
Well, this is key. This is something we have to think about as we go towards transition. If you pull supply in any scenario, you're going to see a price spike. In the US, we're seeing less refinery production than we have a few years ago. So you're seeing over 1 million barrels per day cut in the last 2-3 years alone. And when you have less supply of something, even if you have less demand, it really depends on which one goes first and how speedy that changes.
And so what are people thinking? When will this all shake out?
I mean, it's shaking out already. It's already shaking out in the forecourt when people are buying their car. You're seeing the response from refiners, for example. Some big refineries like P66 are switching some of their facilities to make things like renewable diesel or sustainable aviation fuel. So people are posturing. Companies are posturing for the next 5, 6, 7 years, right?
Mm-hmm. Which is such a great point, because I guess the question then becomes, if we're posturing for the 7 or 8 years, what does the landscape in your world look like then? I mean, everyone seems to say it's a yes and. We need everything above all and. Is that how you model it?
That is how we model it, yeah. In our sort of standard outlook, 2029 we see peak oil consumption globally, so that's still pretty far out. There's still a lot of growth left.
Also, peak doesn't mean then that it goes to zero.
Correct.
I feel like that's something we need to also wrap our mind around. Like, just because it's not increasing doesn't mean it's rapidly decreasing.
Yeah, you're totally right. Even in a net zero world in our modeling, you get about 25 million barrels per day of oil. So, net zero doesn't mean zero oil.
So what is the growth outlook here?
You're looking at about 4 or 5 million barrels per day upside in our base case scenario, but lots of things can change that, right? Policies are the main thing to look at, particularly in big markets like the US, right? The US consumes about 1 in every 5 barrels globally. So if something changes here, the whole market can change. The dynamic is really upended.
When we take a look at, say, China and India, large consumers of energy, obviously, are they jumping from coal to what?
Gas is a transition fuel. We're seeing them shift towards. I was just in Beijing last week, and there's a very different way of looking at the oil market versus if you're down in Texas, right? It's what's the displacement, because they need more and more energy, right? They don't want to import that energy, so what can you do domestically? In the case of power, that's coal. But we're also seeing in the case of EVs, right? LNG trucks, even electric trucks. So we have a lot we can learn from them, but they're just very different markets.
And how do they get there? Is it because of subsidies? Is it because they were so dependent on coal? Like, what leads that transition there differently than, say, in the US?
Yeah, I mean, I think it's dependency on imports. They're one example. They've got a lot of national champions. And to be honest, when they say they're going to do something, they do it. In Europe and in the US, you got to get it through parliament. You got to get it through votes. It's a lot slower of a process. And there's less domestic manufacturers. Like Tesla's a big player here, but that's kind of it. In China, you've got a lot of big producers, a lot of big industrial champions, right? And they're encouraged by the states and by the cities and by incentives.
So how do we fit into the bigger international ecosystem?
Well, for the US, one of the most important things is its sort of gasoline production machines. They send a lot of gasoline abroad, South America, Europe even. So there's a change coming along for your US refiners, basically, and you're starting to see how they adjust their positioning in a sort of a market-leading way, I think.
All right, David, we appreciate it. Thank you very much. David Doherty joining us, head of oil and renewables fuels research for Bloomberg.
Before you go, have you ever had a non-alcoholic beer?
Oh, bring the Irish guy in. I like this. I have, yeah, and I'm also not averse to it. I'm with Alix on this one. Yeah, I think it's pretty good, especially if you're driving, you know.
Yeah, or just like you because some of them you actually can feel the taste. Like non-alcoholic wine is basically like fruit juice, but non-alcoholic beer does taste somewhat like beer.
I agree, and you know what? It stops people asking you like, "Why aren't you drinking today?" Because they have no idea. It looks the exact same.
Yeah. Well, and
the more you know.
John Tucker?
You just all disappoint me.
Oh, so sorry. The alcohol removed wine, though, that's I tried to get into that, and it was like, guys.
What about the hot wine? What's the word for that warm wine? That
stuff? What mold stuff? But that's not wine. What?
Is it not?
Bad.
Okay, now we're going to research this.
This is when I back away.
This is Bloomberg.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.